Rocket Mortgage, Redfin, and Mr. Cooper walk into a bar. Bartender says, "What'll it be?" They respond, "We'll take this home buyer's personal financial data, their home search history, and 30 years of their income, please." Okay, not the best joke, but that's essentially what's happening with the recent $12 billion worth of acquisitions Rocket Companies has done the last few years. Now, I've been a practicing mortgage professional since 2007, and I've seen every gimmick lenders use to hook buyers, and these are some of the worst. But how does it affect you as a home buyer? You see, when Rocket bought Truebill, now Rocket Money, for $1.3 billion, they gained access to your complete financial profile, your spending habits, saving patterns, and bill payments. Combine that with Redfin's data on your home preferences and Mr. Cooper's mortgage servicing platform, and they've created a system where they know your finances intimately more than you do. Today, I'm breaking down these mergers and what could happen with your data when these companies combine, and share your data and what you can do as a smart home buyer to counter it. I think you agree that Rocket Companies didn't just spend $12 billion buying up companies for fun. They're taking control of every step in your home buying journey. This should make you pretty nervous. When Rocket announced its plans to buy Redfin for $12.9 billion, the financial press called it a strategic acquisition. But they didn't highlight what this means for you as a home buyer. Now, you're viewing properties on a platform owned by the company selling you a mortgage. This changes who is really working for you. You see, the traditional home buying process used to have natural checks and balances. Your real estate agent helped you find the best house. Meanwhile, your mortgage broker searched for the best loan. When one massive corporation controls both sides, those checks and balances vanish. Here's how this could play out. Potential home buyers will use Redfin to search for homes. Next, they get the Get Pre-Approved button. They expect to get competitive offers. Your info went straight to Rocket Mortgage instead. This led to a rate about 0.5% higher than what you could find on your own. Over 10 years, that cost you $21,000. Super convenient, right? Think about what happens when you use these consolidated platforms. Your information isn't just going to a marketplace of lenders competing for your business. It's going straight to the parent company's mortgage division. They want to keep you in their system. They control everything from search to closing and servicing afterwards. Can you really afford an extra $300 every month on your mortgage? That's what industry data shows what happens when home buyers don't compare different lenders. This amounts to $3,600 a year, over $100,000 across a 30-year loan. These corporate giants are banking on you not making those comparisons. In fact, data suggests that you won't. Based on NAR and other stats, nearly 80% of home buyers use the first realtor and lender they talk to. Now, have I been the beneficiary of that over my career? I'm sure I have. Bottom line is that it pays to shop around for your mortgage. And this consolidation extends beyond just a single company. It's creating a domino effect across the entire mortgage industry. Now, Mr. Cooper, another mortgage giant, had been on a similar acquisition spree, gobbling up servicing rights to millions of mortgages. And that's why Rocket decided to acquire them too, to gain access to you as a customer, even if you didn't use Rocket when you got your mortgage. So what could happen during your home search in this model? Well, your Redfin agent or any other agent buying leads from Redfin may recommend Rocket Mortgage. They say it can streamline the process and help ensure a smoother closing. Still, they often skip over the financial incentives or the corporate pressure that push this advice. It's about their bottom line, not your best interests. The marketing of this consolidation as beneficial to consumers is particularly troubling. Streamlined, rapid, user-friendly. These are terms to describe a system built to limit your choices and maximize their profits, not your home buyer experience. So what's the alternative? Work with an independent mortgage broker like me who shops your loan across multiple lenders. You work with real estate agents who aren't linked to certain lenders. Avoid those with corporate ties or in-house lenders that pay for leads. But it can mean save hundreds of thousands of dollars over the life of your loan. And that effort really pays off. When you see an ad for a one-stop shop home buying experience, know what advertisers are really offering. It's captivity. This system leads you through steps that seem helpful, but really they aim to maximize profits from your transaction. The most dangerous aspect, most home buyers don't realize this is happening. People believe experts care about their needs, but the truth is the system now favors shareholders over home buyers. Now, before we get to the next point, my name is Emmett Dempsey. I'm a mortgage broker and owner of Treasure Coast Mortgage here in Port St. Lucie, Florida. And if you do me a favor, if you're getting value from this, go ahead and tap the like button to let YouTube alert other home buyers of this news. And also please subscribe to the channel if you haven't already. Also, if you're in the market right now or thinking about it, feel free to reach out to me. You can email me or book a call that works for you in the link in my description. Now, with that out of the way, let's talk more about these mergers. So let's talk real numbers now. Small differences in mortgage rates can have a huge impact over the life of your loan and really shock you if you saw them. But that's exactly what these big lenders are counting on. that you won't do the calculations. When large mortgage companies casually say their rates can be a little higher, they hope you'll think more about the house and less about the loan. Here's the tough truth about the numbers. If you have a $300,000 mortgage, a 0.25% higher interest rate will add over $20,000 in extra cost over 30 years. I mean, imagine a tiny leak in a boat. At first, you might not see it, but over time, it can flood your cabin and drown you. The damage escalates quickly. A 0.5% higher rate means paying $40,000 more in interest. 0.75% higher, handing $60,000 more straight from your bank account to their corporate profits. I mean, that's a luxury car or your kid's college education, guys, disappearing from your future. What does this mean for your financial security? Everything. These companies disguise these costs masterfully. Rocket Mortgage and similar lenders often use marketing tactics to downplay long-term expenses, and they'll give upfront credits, like appraisal credits, which look good on paper now, but these are not worth it compared to the higher interest rate over 30 years. It's a classic bait and switch. They hand over you $500 now and quietly collect $50 more per month for the next 30 years. The compensation structure for the loan officers also reveals their true priorities. These LOs' quarterly bonuses are directly tied to giving you their higher company rate. They get penalized for any pricing exceptions. And this fundamental conflict of interest works against you from the very beginning. When someone profits directly from charging you more, they're not looking out for your best interests. Independent mortgage brokers like me have a broader selection of lenders. I also provide more transparent compensation. In fact, the Dodd-Frank laws passed after 2008 make it so lenders like Rocket don't have to show everything that they make, like I have to. We're very transparent because by law. My business's focus is on getting you the best rate and terms, and my success comes from referrals, not from squeezing profit from one deal. These companies have perfected their approach through extensive consumer behavior analysis. They've calculated precisely how much extra they can charge before customers walk away. They're betting on your exhaustion, the home buying process, your excitement about the house, and your trusted familiar brand names. You spend a few hours comparing lenders, guys. It could save enough to change your financial future. Is convenience really worth sacrificing decades of financial freedom? I don't think so. Ever wonder why a mortgage giant would drop $1.3 billion on a simple budgeting app? When rocket companies bought Truebill, now Rocket Money, they gained more than a subscription cancellation service. They got a direct link to your financial life. I mean, think about that for a second. This app handles more than $50 billion in transactions each month. Since 2016, it has saved members over $1 billion. Hey, let's give credit where credit's due. Hidden subscriptions aren't fun. In fact, I found a few of myself recently, and they do save money. But that consumer benefit is just the surface level story. Behind the scenes lies a strategic master plan. Connecting your bank accounts to Rocket Money, it gives you great financial insight. You can see your spending patterns, income changes, bill payment history, and savings habits. This comprehensive data flows directly to the same company that might offer you a mortgage one day. The data collection gives Rocket a unique edge. It helps you understand how much house you can really afford, often before you realize it yourself. The app tracks your regular spending and spurges. It also checks your debt-to-income ratio and looks at how well you stick to your financial goals. With this profile, they can calculate your financial breaking point for certain mortgage terms. Here's how this could play out. Let's take an example client. Let's call her Sarah. She got a mortgage offer that felt personalized and fit her budget perfectly. She didn't know that Rocket had looked at her spending habits. It saw she hardly compared prices for big buys. Then it gave her a rate that was 0.3% higher than the best offer. The offer felt tailored to her needs because it was, but not for her benefit. Now, this is a hypothetical scenario, guys, but I think you can see what I'm getting at. The implications are pretty significant when one company controls all this data. When you apply for a mortgage with Rocket, they already see if you max out credit cards, live paycheck to paycheck, or have savings. I mean, they know if you're likely to accept a higher rate because your spending patterns shows you prioritize convenience over cost. I mean, they know exactly how much more they can charge before you walk away. This is their business model. I mean, research shows that Rocket Money looks closely at how people spend. This analysis connects directly to Rocket's AI systems. Their statements show they use this data to personalize and automate consumer experiences. That is quoted from their own press release. This means they optimize offers based on your financial behavior to make more profit. It's like sitting down at a poker table where your opponent sees all your cards. That's what happens when a mortgage company accesses your complete financial profile. You think you're negotiating fairly, but they know your highest offer. They also understand your financial weaknesses and which loans will attract you based on how you spend. The effectiveness multiplies when they combine financial data with home search behavior. If they notice you checking out the same property for weeks and see your bonus, they can make a tempting offer. It may look good enough for you to accept it, but it won't be their best deal. I mean, their systems spot emotional triggers that push you to accept a mortgage without exploring other options. Are you impulsive with large purchases? Do you choose convenience over cost? Have you searched specific neighborhoods for months on end? And this information helps them craft a perfect pitch at the right time. Most concerning is how they identify which customers comparison shop and which don't. The data uses improved automation, personalization, and efficiency, again, from their own press release. It finds customers who need competitive rates, but it also spots those who can be charged more because they won't notice or they won't care. This creates massive information asymmetry in negotiation. When you're applying for a mortgage, you got to provide documents about your finances. I mean, look, it's the same documents I ask my clients for. But these data gathering tools give a clear view beyond old documentation. They reveal if you save money or you spend on impulse. You can see if you focus on savings or instant rewards. Plus, they show you which offers might keep you from shopping around. I mean, that explains the $1.3 billion price for a subscription management app. Rocket gained deep insight into millions of potential mortgage customers. And they also gather data that predicts how people will respond to various offer types now offered through Mr. Cooper. Guys, this isn't just about one mortgage offer anymore. Rocket is playing a much bigger game. They bought Truebill to watch your spending. They bought Redfin to track your home search. And they bought Mr. Cooper to control your loan after you close and deliver offers that are timely. That means they're with you from the moment you browse a house until the final mortgage payment 30 years later. The more data they control, the more they profit, unless you stop and compare. And I love to help. If you have a loan estimate from any lender, and you want a second opinion, I'd be happy to compare pricing. You just shoot me an email with the LE attached, and I'd be happy to help. Thank you so much for watching. Please like and subscribe if you haven't already, and I'll see you on the next one.